Most people think wealth is built when the market feels good. That is not how serious wealth is built. Serious wealth is usually built when the market feels wrong, when prices are falling, when headlines sound dangerous, when your relatives are telling you to wait, when your own brain is begging you to do nothing until the sky looks cleaner. That is when the real window opens. Not because pain is magical, because fear distorts price faster than it destroys value. And if you know the difference, you can buy the future while everybody else is trying to hide from the present. That is what this moment is really about. Not easy money, not some lucky trade, not a fantasy where you guess the bottom to the day and retire on a chart. This is about understanding what kind of assets get repriced during a fear cycle. What kind of assets deserve that punishment, and which ones are simply being marked down because human beings hate uncertainty more than they love arithmetic. That is where the opportunity lives. And almost everybody misses it for the same reason. They do not miss it because they are stupid. They miss it because they wait for emotional permission. They want the market to feel safe before they act. But by the time the market feels safe, the discount is usually gone. That is the first rule. Opportunity does not arrive wearing reassurance. It arrives wearing confusion, fear, ugly headlines, and temporary mispricing. That is why the public almost always misses it. If you want the mother line for everything in this story, here it is. The once in a decade wealth window is not created by the crash itself. It is created when fear temporarily prices good assets as if time has stopped, while disciplined capital keeps buying because it knows time has not stopped at all. That is the line. Read it again. Because once you understand that, you stop asking the wrong question. You stop asking, is the market safe yet? You start asking, which assets are being repriced below their future earning power because the crowd is reacting to pain instead of duration? That is a better question, a much richer question. And it is how fortunes get built without needing genius luck or some secret number whispered by a hedge fund manager. The average person is told a childish version of wealth building: work hard, save what you can. Put a little money in the market, do not look too often. Hope history repeats kindly. That is not terrible advice. But it is incomplete because there are moments in every cycle when history does not just repeat kindly. It offers a temporary discount on ownership. And the people who recognize those moments, prepare cash and conviction in advance, and keep buying while others freeze, are the people who change their financial lives permanently. That is what I want to walk you through. Not a fantasy, a mechanism, not slogans, a sequence, not buy the dip because it sounds brave. Buy what deserves ownership when fear is creating a sale on time. That is the actual game. Now, let us begin with the first mechanism. I call it the fear gap. The fear gap is the distance between what an asset is worth over time and what frightened people are willing to pay for it. During a stressful window, definition is simple. Price falls faster than value. That is the gap. When a business or an asset gets repriced in a panic, the market is often not calmly recalculating 10 years of future cash flows with perfect clarity. The market is trying to get rid of discomfort. That is a very different behavior. A person selling because he lost conviction after careful analysis is not the same as a person selling because the screen is red, the news is ugly, and he cannot bear another bad week. The problem for ordinary investors is that those two kinds of selling produce the same price decline on the chart. The chart does not tell you motive, it only shows you outcome. That is why most people get trapped. They see a falling price and assume value must be collapsing too. Sometimes it is. Sometimes it is not. And the entire game of opportunistic wealth building lives inside that distinction. Think about a strong business that made real money last year, will probably make real money next year, serves customers who still need its product, has a good balance sheet, and then gets knocked down 25% because the market suddenly decided every risk at once deserves the same fear premium. What exactly changed? Did the company lose a quarter of its future worth in a week, maybe if fraud was discovered or the product became obsolete overnight? Usually not. Usually the price moved faster than the business reality. That difference is the fear gap. The crowd experiences the gap as danger. The disciplined investor experiences it as a temporary spread between present emotion and long-term earning power. That is how wealth gets built. Not by hoping every red candle is opportunity, by recognizing when fear is moving much faster than the underlying value. Now let me sharpen the point. A stock chart cannot tell you whether you are looking at a dying business or a healthy business being thrown into the same basket as weaker things. That work is yours. That is why fear creates opportunity only for people willing to classify instead of merely react. The public sees all falling assets as risky. Serious capital separates temporary markdown from permanent damage. That is the edge. Now let us move to the second mechanism. I call it the rate shock discount. This is where a lot of the current opportunity is actually coming from. A lot of assets are not down because their core value disappeared. They are down because the era of free money ended and markets had to reprice everything that had been living on borrowed generosity. That matters for years. Cheap money made almost every asset look more intelligent than it really was. If rates are near zero, you can borrow cheaply. If you can borrow cheaply, bad businesses survive longer. Housing gets bid higher. Speculative growth receives richer multiples. Private assets get valued like optimism is a physical law. And investors lose the habit of demanding true earning power. That was the party. Then rates rose. Suddenly, the world remembered that money has a cost. And when money has a cost, valuation changes. A company promising profits far in the future is worth less today. If the discount rate rises, a real estate asset financed on cheap debt looks much less attractive. If the financing cost doubles, a flashy business with no free cash flow looks a lot less romantic when capital is no longer free. That is the rate shock discount. The key thing to understand is that rate shock does not destroy value evenly. It punishes excess, it punishes fragile structures, it punishes stories that needed cheap capital to feel believable. But it also drags down good assets along with the garbage because broad fear does not stop to sort carefully in real time. That is the window. The window opens when the market is doing broad repricing and the public cannot tell the difference between a deserved markdown and an indiscriminate one. That is where a person with patience can do very well. Now let me be specific. A great business with real cash flow may still have been overpriced in 2021. Fine, a 25% or 30% decline does not automatically make it a gift, but it may turn an untouchable price into a sensible price that matters. A good real estate deal that made no sense at a 3% mortgage might still not make sense at 7%. Fine, but a quality property purchased by a patient buyer who can tolerate current financing pain may become very attractive when the cycle normalizes later. That matters too. You do not need every repricing to equal an immediate bargain. You need enough repricing that future returns become materially better than they were when easy money was still flattering everything. That is the rate shock discount. Now let us move to the third mechanism. I call it the time harvest. This is where most people fail, and the failure is not intellectual, it is emotional. The time harvest is the process of buying during ugly periods and then letting time, not drama, do the work. That sounds simple. It is hard. Very hard, because human beings want visible proof that they were right. They want their decision rewarded quickly. They want to buy and then see the line go up. But the market rarely rewards disciplined buying with immediate applause. Usually it insults you first. That is what people cannot tolerate. They buy after a correction and then the market falls another 8%, another 12%, maybe another 15%. Now they feel stupid. Now they tell themselves the thesis was wrong. Now they stop. That is how the time harvest dies. Not because the underlying logic failed, because the investor wanted emotional relief faster than the cycle was willing to provide it. The truth is that once in a decade opportunities usually do not look like genius on day one. They look like discomfort. They look like averaging into quality while the world is still uneasy. They look like buying good assets and then waiting longer than your ego wanted to wait. That is why only a minority capture them. Everyone says they want long-term wealth. Very few people actually want the emotional timeline that long-term wealth demands. And the emotional timeline is cruel. It asks you to act before the crowd applauds, hold before the headlines improve, and continue before the outcome feels obvious. That is the time harvest. If you cannot do that, you can still invest successfully in a broad, simple way. But you will rarely capture the full force of a genuine mispricing cycle. Now let me make this even plainer. If you buy strong assets only after the news turns reassuring, after the market has already recovered, after central banks sound friendly again, after analysts have all upgraded their outlooks, you may still make money. But you are no longer harvesting time. You are paying for comfort. Comfort is expensive. Time is where the real money lives. That is what the great accumulators understand. They do not need immediate vindication. They need eventual arithmetic. That is a different kind of discipline. Now, let us move to the fourth mechanism. I call it the quality divide. This is what separates an opportunity window from a junk sale. A downturn is not a gift basket. It is not an invitation to buy everything with a lower sticker. A lot of things deserve to be down. A lot of things that fell 50% can still be too expensive if the business is weak. The balance sheet is ugly, the cash flow is imaginary, or the model depended on a world that has already ended. That is why I hate lazy. Buy the dip language. The dip in garbage is not opportunity. It is often just gravity finally being allowed to work. The quality divide is the line between assets whose future earning power remains real and assets that were only floating because the cycle was easy. This is where serious money lives, not in guessing whether the Nasdaq bounces tomorrow, in knowing which businesses, properties, funds, or skills deserve capital because they can keep creating value in a less forgiving environment. I care about cash flow. I care about balance sheets. I care about demand that survives stress. I care about pricing power. I care about managements that do not need fantasy to justify the stock price. Those are the things that matter. Not every company that fell in 2022 or 2023 or 2026 is a bargain. Some are merely less insane than they were before. That is not enough. A true opportunity is good value with staying power. That combination is rare, but it appears more often during fear cycles because the market temporarily stops distinguishing enough between strong structures and weak ones. That is why the window matters, and it is why ordinary people still have a chance inside it. You do not need a Wall Street budget to identify cash flow, debt load, recurring demand, and reasonable valuation. You need patience and honesty that is much cheaper than genius. Now let us move to the fifth mechanism. I call it the compounding edge. This is where the whole thing becomes life-changing rather than merely interesting. The compounding edge is what happens when you buy better prices earlier in life or earlier in a cycle and then let many years of return build on that lower starting point. Everybody wants a quick win. The real fortune comes from changing the base that compounds for decades. That is why downturn opportunities matter so much. They are not just about the first bounce. They are about the entire future built from that entry level. If you invest $500 a month and the market offers you cheaper prices for a period of time, you are not just buying on sale in some emotional sense. You are acquiring more ownership for the same labor, more shares, more claims, more future cash flow participation that matters enormously over 20 or 30 years. People underappreciate this because the arithmetic is too quiet to feel dramatic in the moment. But compounding does not need drama, it needs time, and a decent starting point. That is why the best wealth windows often feel boring when they are actually being used properly. No one is throwing confetti for your monthly purchases into diversified funds, strong businesses, or real assets when the news is still ugly. Find that compounding does not care. It only cares that the claims were acquired and held. That is the edge. Start earlier in the cycle, even imperfectly, and the gap over decades becomes enormous. Wait until everything feels safe and you may still do fine. But the gap in ending wealth can be staggering. That is what people miss. The cost of hesitation is not only the missed bargain, it is the compounding that never gets a chance to begin from those prices. Now let me say this in the hardest possible way. If you wait 5 extra years because you wanted certainty, the price you pay is not just 5 years. It is the entire compounded value of those years. That is brutal. And it is why I keep telling people that once in a decade opportunities do not need to be used perfectly to matter enormously. They only need to be used at all. Now let us move to the sixth mechanism. I call it the skill engine. This one gets neglected because people love to think wealth comes only from external investments. That is incomplete. The skill engine is your ability to produce more cash flow through work, business, or specialized ability, and then convert that cash flow into ownership while assets are attractively priced. This matters because most ordinary people do not become wealthy by finding one magical stock. They become wealthy by increasing their earning power, increasing their savings rate, and directing that growing stream into durable assets during long stretches of compounding. That is not sexy. It is still how a lot of real wealth is built. A downturn can make skill investment even more valuable. Why? Because weaker competitors leave, because employers suddenly care much more about who can actually produce results, because the person who learns data skills, AI tools, marketing, software, sales, financial analysis, operations, or some business critical craft in a stressed environment often emerges into the next expansion with much greater earning power than the person who spent the same period only doom scrolling the market. That is the skill engine. Your labor is not separate from your portfolio. It is the funding source for the portfolio. And when the opportunity window is open, better labor economics mean more ammunition for ownership. That is why I never laugh when someone says the best investment right now might be in themselves. Sometimes it is. But I want to say it more precisely: investing in yourself matters most when you tie it to an asset acquisition process. A new skill with no discipline behind it is just potential. A new skill that raises your income and funds ownership of underpriced quality becomes a compounding engine. That is different. Now let us move to the seventh mechanism. I call it the safety illusion. This is the trap that makes people miss the whole opportunity. The safety illusion is the belief that sitting in cash until everything feels better is the same thing as being prudent. It is not always prudent. Sometimes it is just delayed fear. If you hide in cash during a fear cycle and only come out once the market recovers, you have not avoided risk. You have simply exchanged temporary discomfort for permanent under ownership. That is a bad trade. I am not saying never hold cash. Cash has a job, liquidity, optionality, emergency stability, fine. What I am attacking is the emotional use of cash as a waiting room for certainty. Certainty is almost always offered at worse prices. That is one of the oldest truths in finance. The more obvious the opportunity, the less generous it usually is. The market does not pay you for joining the line after the fire drill ends. It pays you for being willing to act before everyone else has emotionally healed. That is the safety illusion. People tell themselves they are being disciplined. Often they are simply avoiding the feeling that accompanies true opportunity, because true opportunity feels bad in the present. If it felt easy, the price would not be attractive. That is the point. Now let us move to the eighth mechanism. I call it the window discipline. This is the operating system. This is what separates people who admire opportunity from people who actually use it. The window discipline begins with a simple understanding. You do not need to predict the exact bottom. You do not need a heroic all. In moment, you do not need to know which week marks the final low. You need a plan, a real one. Regular buying, quality filters, cash reserves for emergencies, a rule for increasing exposure when prices improve, a rule for refusing to chase garbage just because it fell, a rule for continuing even when you do not feel good. That is the disciplined dollar. Cost averaging matters here because it removes the burden of perfect timing. If you invest regularly through a fearful period, you capture lower prices without needing to sound smart about the bottom. That is useful. Very useful at the same time. The window discipline demands selectivity. Not everything cheap deserves your money. High debt, no cash flow. Weak demand, impossible valuations, fragile narratives, and assets that only worked under zero rates are not automatically bargains because they fell. Some things are simply breaking. That is why the discipline has two sides: consistency and selection. Without consistency, fear wins. Without selection, stupidity wins. You need both. Now let me show you how the opportunity actually lays itself out. There are three broad areas where people can build serious wealth here if they behave correctly. The first is quality equities, not memes, not fantasies. Real businesses, strong earnings, competitive advantages, reasonable or improving valuations. When the market reprices these down with everything else, I care. That is where buying can matter. The second is real estate, where the numbers still work, honestly. Not all real estate. Do not romanticize it. A bad property bought at the wrong basis is still bad. But financing stress and fear create pockets where buyers with patience and sound math can buy future cash flow more attractively than they could in the easy money years. The third is the skill engine we discussed, because future wealth is built not just by buying assets, but by increasing the stream that buys the assets. Those are the real areas, not the noisy stuff, not the addiction assets, not the "this coin will change your life" nonsense that appears every cycle to bait people who want to escape faster than they want reality. That is why I say wealth building is not about hacks. It is about structure. Now let me make the identity flip explicit. Most people think the point is to be fearless. Wrong. The point is to be systematic under fear. Fearless people do stupid things. Systematic people do uncomfortable but rational things. The fearless fool buys junk because it is down. The systematic investor buys quality because it is mispriced. The fearless fool swings for the fences with money he cannot afford to lose. The systematic investor keeps funding ownership month after month while the market offers discounts. The fearless fool wants a story. The systematic investor wants a future cash flow claim at a better price. Those are different people. The market pays them very differently. That is why I do not tell you to become brave. I tell you to become structured. Structure beats courage over long stretches. Courage without structure is just emotion wearing nicer clothes. Now let us talk about the ordinary person advantage, because it does exist. This is not only a hedge fund game. Large funds have constraints. They have mandates, they have committees, they have optics, they have redemptions. An ordinary person with a stable income, a growing skill base, low leverage, a long horizon, and a disciplined buying plan can do something a lot of institutions struggle to do. He can keep buying quietly without needing to explain himself every quarter. That is an enormous advantage. Do not underestimate it. A person who can automate contributions, ignore headlines, and keep buying quality through an ugly 18-month window can easily outperform a great many louder, smarter-looking people who spent the same period reacting emotionally to every macro twitch. That is the hidden edge of simplicity. Now let me say something blunt. If you are waiting for the market to tell you that the opportunity is real, you are already negotiating against your own future. The market will tell you eventually, it will tell you with higher prices. That is how the message is delivered. By the time the headlines turn optimistic and the economic language softens, a big chunk of the easy repricing is already over. That is why the best time to build is when the emotional weather is still ugly. Not because pain guarantees profits, because fear often gives you prices you will not see again once comfort returns. That is the whole point. Now let me put the operating system in plain language. First, accept that downturns are not only dangers, they are transfer events. Second, maintain enough liquidity that a market drawdown does not become a personal emergency. Third, invest regularly, instead of worshiping perfect timing. Fourth, separate quality from junk ruthlessly. Fifth, keep building your income power because it funds the ownership plan. Sixth, use tax-advantaged accounts aggressively when available because tax friction compounds against you just as powerfully as investment returns compound for you. Seventh, do not wait for safety feelings. Wait for sensible price to value relationships. Eighth, remember that the biggest gains often begin in the middle of the ugliest weeks. That is the operating system. It is not dramatic. It is powerful. Now I want to say something especially hard to the person who thinks this entire conversation is really about whether the market goes lower next month. That is too small. That obsession is how people miss the whole point. A once in a decade opportunity does not require you to know next month. S candle. It requires you to know what kind of behavior, structure, and assets will matter if the next several years are built from today. S fear cycle. That is a much bigger and much more useful question. It is the difference between trader thinking and wealth. Builder thinking. Trader thinking asks, am I right now, wealth? Builder thinking asks, am I acquiring strong claims at better prices than I could have gotten 2 years ago? That is the question that changes lives. And that is why I do not care if someone tells me. But the market could still go down more. Of course it could. That does not cancel the window, it defines it. The window is not a one-day event. It is a period in which repricing creates better future return conditions for disciplined capital. That is exactly where we are. Not at the euphoria top, not at perfect clarity inside the window. Now let me put the blade into this as cleanly as I can. Most people are going to miss the greatest wealth, building opportunities of this cycle, not because they lacked money, not because they lacked intelligence, and not because Wall Street hid the truth from them. They will miss it because they will wait for the market to stop feeling scary before they start buying what is being sold at a discount precisely because it still feels scary. That is the trap. And the way out is not brilliance. It is discipline, quality, time, income, consistency. The people who build serious wealth over the next decade will not be the ones who guessed perfectly. They will be the ones who understood that the sale had already begun, that fear was doing the markdown work for them, and that the correct response to a window like this is not panic and not paralysis. It is prepared action. That is the whole story, not luck, not magic, prepared action. And if you remember nothing else from what I said, remember this. The once-in-a-decade opportunity is not coming. It comes in pieces while the news is still ugly, while the prices are still confused, and while most people are still too frightened to call it by its real name. Wealth window, use it or miss it, but do not misunderstand it.